Good morning. We're here to talk about Silicon Valley real estate, week 22. This is looking at the sale price to list price distribution for each week. The purple line is the current week. The burnt orange was last week. So you can see there was a slight improvement. The best line we ever had was the dotted red line up here, which was March 26. And then you basically have come down since March 26 with a slight improvement this last week. And it was mostly at the upper end with the buyers paying the most overbidding. For example, 5% of the buyers that closed last week were willing to pay 127% of the seller's asking price. Now, this current week, they're willing to pay about 131%. So there's been about a percent increase at the high end. On the low end, there's basically been no increase at all. And in the middle, it's right on top of it. So no increase or decrease. And here are the most recent 12 weeks. So you can get some separation. March 26 is the dotted line up here at the top. And it's not always at the very top, but it had the highest median and the highest average, as well as the bulk of the time it was the highest line. So that's how I picked that as our best week ever. We can't really complain because these are very good numbers, but I want to caution people that this is 5 weeks delayed because of length of closings. This is now looking at just the offers accepted, and pay attention to the right-hand side here. Yes, this is impacted by Memorial Day inventory or offers accepted after a holiday. And I talk about every holiday negatively impacting the volume of transactions, except for Mother's Day and Valentine's Day, which has a slight positive impact. But the takeaway is the broad, bold blue line is the current week data. It is now the lowest year out of the last 8 years, and that has to be significant. You don't have to go back very far that the only year that was beating us was 2021, and 2021 was unusual because it had the pent-up demand from the pandemic. And you can see the change happened right here, somewhere right around April the 8th, and this is offers accepted. So this is real time. This is what the buyers are doing. Now we're looking at the available inventory, and the available inventory is above 100%. For the last year, ever since shelter in place, we've had below, because here's last year, 2021 on the right-hand side of the purple line, you had significantly below the level of inventory you'd expect for that time of the year. You started off this year the same way, and then again, right around April the 8th, you started climbing, and you started climbing from about 80%, or if you go back a little bit further from 70%, you hit 100%, and now you're somewhere around 107% of the inventory you'd expect. So you have more inventory for buyers to pick from. Similar side of that is the new inventory, what came on in the last week. And you can see you have huge spikes. And remember, Memorial Day was late this year, so that explains this huge run up, not last week, but the week before. And now last week you got impacted by Memorial Day, and now you're back up to about where you'd expect it to be. So this is just a weekly perturbation because of the holidays. But let's flip to the demand side. That's the red line. And so you can see all of last year, you were about 110%. Most of this year, you were about 105, 107%. Then all of a sudden, right around April the 8th, we went down and we were below, and we got down to 80%. Most of it was somewhere right around 90%. Now we're down around 70%. That really doesn't bother me because it's the holiday. I do expect this to come up, but I don't expect it to come back up to 100%. So we have less demand all of a sudden than normal. Once you have less demand, your inventory is going to build up. This now is looking at the ratio between the supply and the demand. And that's important because in a free economy, that is what is driving future prices. The yellow line is the 5-year median 2015 through 2019. The blue line is the current data. The thin blue lines are my warning bells. That's 5 days of gain in DUI in a week. And you can, I raised it up a couple weeks ago and said, hey, let's pay attention. And then it leveled off, so it was no big deal. And we, last couple weeks were pretty level, but look at the shoot up here. And now, even if I come all the way back here to week number 18, and you look at my 5-week slide, it's actually steeper for the last several weeks. So that's a warning flag. You can't take too much merit on this because the week after Memorial Day, there's going to be a whole lot less offers because there was less inventory the week before that. And so I do expect this to come down and get below my warning line, but we're right on the threshold. The only reason I'm really not sounding the alarm bell is pay attention to the baseline. The baseline's going up pretty steeply at this time of the year. So we're going up more rapidly than you would expect, but not so rapidly that I'm willing to say that we're changing the marketplace like we've done a flip from a seller's marketplace to a buyer's marketplace. We're clearly changing, but not that dramatically. Now what we're looking at is simply the number of new listings coming on the market compared to the number of offers. So the blue line is new inventory. The orange line is the number of new offers. You can see that the two lines for years now, since 2019, were pretty much very similar to one another. Yes, there's times when the offers are above the supply and there's times when the offers are below. But look at this huge separation we have now for the first time. And you got to remember that we've been in a seller's market since at least 15 and probably actually since 2011, if you want to look into it, and potentially even since January of 2010. Yes, the market was in the tanks in 2010 and values were down, but the market was rapidly improving. And so we've had 12 years, 13 years of a strong marketplace. And now for the first time, we have new listings coming on the marketplace greater than the number of new offers that are taking inventory off. Also, look at the huge drop off in the number of offers since April the 1st. And yes, there is normally a drop off. Here's April the 1st of last year. The drop off didn't happen until mid-May. If you go back to 2020, we had the huge impact from COVID. So that's really not a good comparison. If you go back to 19, again, the peak was probably mid-May probably right about mid-May. So the fact that the peak happened here real close to April the 1st is 45 days earlier than you'd expect to, which is again an indication the market has lost its steam a little bit. Here's the DUI doing the 5 days per week gain. And you can see basically from about April the 8th, we're right on that trajectory. Here are my little level spots, and these are not as noticeable because I'm now going back to 2019 instead of just a full year, 52 weeks. It's right there on the threshold. And if you look about it, what's on this line? Every speak, this is the end of the year, 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 this is COVID. So the only peak, the only slowdown that came close to raising the alarm, other than the end of the year, which is a holiday impact, was COVID. And COVID was quite a bit steeper than my 5 days per week. We're right close to what COVID was. And if you think about it, COVID, when it was first announced, was we couldn't show any properties. Yeah, people had been out looking and made offers on homes they had seen and that kind of stuff. And that's why it wasn't more abrupt. But that's about as quick as a stop as you can have on the marketplace. And we're not that much below that. Now you're looking at average days on market and median days on the market. I put this up. I don't believe it's very meaningful, but it's something that a lot of people follow. It gets in the media all the time. The reason I don't think it's a very good indicator is look how flat these numbers are. Yes, there was a jump in the average, but except for the couple transactions that came in and really pulled up the average, even the average is pretty flat, where the DUI is raising rapidly. If you were to look at this, you would say no big deal. And at 8 days being the median days on the market, you'd say the market's absolutely on fire. And that's historical data because it takes time for the days on market to build up. And that's why I don't really pay attention to it that much. Here's sale price to list price average and median, and then also the frequency. The average is the blue line, and I normally follow just the average because I was expecting the median to be at 100% a lot of the time, and it really isn't. So I started following both, but you can see the trend is the same. For a buyer, this is, the average buyer's paying 115%, but 50% of the buyers are paying only 113%. You have to understand what you're looking at when you're looking at these different numbers. Typically, the median is a better number to follow, and that's my default. But again, with sale price to list price ratio, I expected a lot of them to be at 100%, some slightly above, some slightly below. So I thought the median would be at 100% for a significant period of time. So I started off following the average, and I've added in the median recently. Here is sale price. And unlike most people, in addition to following the median price, which is the middle, the burnt orange line, I follow the 10 percentile pricing and also the 90 percentile. Keep in mind, this is my macro data. That's Santa Clara County, San Mateo County, single family homes, condos, and townhouses. And that product doesn't exist. This is sort of a number I don't really like to do, but the whole reason for these presentations was to look at the negative impact of COVID, which never happened. This was a quote from the Mercury that I picked up this week And this is why it's important to understand what people are talking about. And they're talking about luxury homes soaring, and specifically in Alameda County. The key here is, how do they define luxury homes? They define them as anything over $2 million. So where you're going to have the biggest increase in luxury homes is wherever the bell curve is starting to reach right in that $2 million range. If you're on the steep part of the bell curve, you're going to have the steepest increase in luxury home sales. That, combined with the price point in Alameda County and the fact that Alameda County had the highest price increase of any of the 4 counties I follow loosely, is why this article was written. It had nothing to do with the actual luxury home market. It has to do with the dynamics of what was happening. With that, that's a brief overview. I'm available to answer any questions, and then we'll go into detail. While you get your questions ready, the green URL is what I call my root URL. That gets you to the YouTube on archive. If you add in 2022 Saturday morning at 9 a.m., you get to the presentation live. If you add in the letter H, the 8-digit year, month, date code, so 2022 0604, you get the handout. I try to get it out 15 minutes before the hour. Today I got it up about 60 seconds before the hour. Do I have any questions before I proceed? Not hearing anything, I'll move on. And now you can interrupt at any time if you have questions. Here, the blue line is your active inventory, and you can see the 5-year median is the yellow line. The 5 years I picked were the 5 years before COVID, 15 through 19, which were all 5 strong years. The fact that you had less inventory than a strong year was pretty significant. The fact that we have slightly more inventory than a strong year isn't significant. But what is significant is the change from a shortage to a surplus in only about 8 weeks. So it happened pretty rapidly, or 7 weeks. It happened pretty rapidly. That's the thing that's significant. I have a new slide that I'll add in a little bit that really brings that home. Now you're looking at the number of new listings. That tracks a lot better than the total inventory. You can see the number of new listings coming on the marketplace. That's significant because a lot of the media hypes about everybody leaving because of COVID and not needing to be near the workplace. Well, if everybody was leaving, there were more new listings than the 5 years before COVID that would be coming on the marketplace. And that simply isn't the case. This is your demand-driven cycle. So you can see that all of last year, we had above the 5-year median number of demand. This year, you started off above, and then again, right around week 15, maybe week 16, all of a sudden you fell below. And we're in a demand-driven superheated marketplace. So now if we've lost our demand, we're going to lose that superheated marketplace. Here's the DUI of the 3 components. The 3 components, the red is Santa Clara County single family home, the brown is San Mateo County single family homes, and the yellow is Santa Clara County condos and townhouses. And you can see the trends are all the same. You can see that you were a little bit less than the 5 days per week gain here until very recently, and then all of a sudden you're much steeper. Keep in mind that I do this data every week, even though I only present once a week. So that's why there's so many data points here, even though that's only a short period of time. These are every quarter. So this is April the 1st. This is basically the Memorial Day holiday impact for the most part, but we're right there at that 5-day per week threshold. This is the DUI mapped out for you. The redder the color, the hotter the marketplace. White is a neutral marketplace, and there is no blue yet, and that would be a buyer's marketplace. And what we want to do here is now compare this just to 3 weeks ago, the 14th. Look how much redder this area is. So that gives you an idea what's happening. And this doesn't need sale price because it's looking at offers accepted, not closings. From May 14th to June 4th, you had a significant slowdown in the marketplace. You can also just look at the numbers. Right now, it's hard to pick a number, but maybe somewhere around 38 days, 36 days, something like that. And then you go to here, and the number you have to pick is something much closer to 20. So a huge change in the marketplace. It's hard to get below 8. So the fact that you went from some number around 15 is really a number, say around 7. And if you're some number around 38, you went from 7 to something like 28. So the slowdown is much more than just the raw numbers account for. Here might be an easier way to do it. This was the slide that delayed me this morning. So here is what we looked at in the different micro market areas: single family homes on the top, condos and townhouses on the bottom. The redder the color, the faster the marketplace. So here's where we were on May the 7th, then the 14th, the 21st, May 28th, and June the 4th. So you can see there's straight across, you've been having a reduction in the colors. They're not all uniform, and Cupertino Sunnyvale has slowed down some, but it's still a pretty deep red compared to, it's been the deepest red for a long time. Foster Cities was also pretty deep, and now it's starting to lighten up quite a bit. Now we're looking at the frequency of overbidding. This is how common is it for sellers to get more than their asking price. And last year, we spent most of the year right around 80%. This year, we were spending most of the time right around 90%. We've dropped down now to probably 85%. If you looked at that number by itself, that would say, that's a crazy 85% of your sellers are getting more than their asking price. That's where we're at. But, we're also going from 90% down to 85%, indicating a little bit of a cooling. And that, again, is lagging data because it requires sale price. So if that data is 5 weeks old and the shift in the marketplace really only happened 3 weeks ago, it's going to be another 2 weeks before we start really seeing it in the overbidding. Here's the frequency of the 3 different components. Red, Santa Clara County single family. Condos is the yellow, and San Mateo County single family is the brown. Here is the overbidding. See how red that map is? That's because it's a lagging indicator, essentially. This requires the sale price. This is how common the overbidding is. So you can see that pretty much everybody's in the high 80s, low 90s. There's a couple exceptions down in South County at 75% basically, and Atherton at 70%, and then probably even the San Mateo County coast, that's at 80. It's unbelievable when you really think about it. But again, lagging data. Here is the magnitude overbidding, and you can see that has come down. So this is the prior buyers feeling the pressure. When they were in the heyday of this superheated marketplace, they were paying almost 16% of other sellers' asking price on average. Now you're down somewhere around 10.5%. That's pretty significant. It's it changes more than the frequency. Buyers are willing to overbid, pay more than sellers' asking price, and they're still willing to do that, but they're not willing to do it by as much as they were just a few weeks ago. And again, that's closing, so it's lagging data. The magnitude, you can see the trends are down pretty significantly on all 3 micro market areas. Here's the magnitude of overbidding graphically. Again, you can see they're all very strong numbers. Here's the sale price, median only. This is countywide, the 3 different ones. So Santa Clara County, San Mateo County, and condos. The dip in condos is fairly unusual, but was there. San Mateo County is a little bouncier because the prices are higher and it's got quite a bit fewer homes. So it's more susceptible to changes due to what's selling. Now, this graph becomes interesting because you got the median price in the different micro market areas in the middle. To the left is the 10 percentile price, and to the right is the 90 percentile. So you can quickly find out what the price range is in the different areas that you might be looking in. It was interesting that I think at last week, maybe even South County was at $1 million. The only holdout was East San Jose, Central San Jose, and South San Jose. I think these numbers will probably be coming down a little bit over time, not dramatically, but we're not going to get every area with a 10 percentile price over $1 million. This is looking at the appreciation since the entire calendar year of 2020. So since the count, and when the median price was right here, and that's for the entire calendar year. This is when the median transactions happen. So the median transactions happen later in the year than the middle of the year. The middle of the year, obviously, July the 1st. This is happening about 5 weeks later, 6 weeks later. The takeaway is look at real quickly, you can see the yellow highlights, which are record highs or tied for record highs. They're now all in the past. We didn't have a single record high this week. And, we're not down dramatically or anything. And there's a fair amount of fluctuation from week to week. But the fact that you had no records set at all is, again, an indication that the market's cooling. Here is the micro market areas and the components that I think are important. Here's your DUI. Notice how much whiter they are than the frequency and magnitude of overbidding, which are very similar. These both require sale price data, so they're lagging data. This is more current data. This is what the future is going to happen for the frequency and magnitude of overbidding. And then here is not an indicator of the marketplace, but a reality check of where the prices are. So again, the middle number is the median, the number to the left is the 10 percentile, and the number to the right is the 90 percentile. And you have single family homes on the top, followed by condos and townhouses on the bottom. Redwood City turns out to be the median price. It's by definition white in color. Below the median is blue in color. The bluer, the more below, and above the median is pink in color, getting to bright red as you get way more expensive. You can see a lot of the areas now are very similarly priced to Redwood City, and those would be Cupertino, Sunnyvale, and Santa Clara County. The base cities, Belmont, Burlingame, and San Mateo County, Foster cities, they're clustered together. You can see there's a whole bunch right at 2.6, but Redwood City happens to be the middle point at 2.35. This now is looking at some key components this week versus last week. You're looking at inventory. We had 93% of the inventory you'd expect, up from 90% last week for Santa Clara County single family homes. San Mateo County went up from 120% to 131%. Santa Clara condos went from 170 to 187. So you can see all of them went up. Base cities, I have it there. It's factually accurate data, but because of the number of condos that were built in that area, it really isn't relevant based on the 5-year data that I'm using as my baseline. Your DUI, my key indicator, you went from 33 to 37. You went from 34 to 43. Huge jump right here. But again, remember, this is the holiday. But now we're going back 5 weeks. The holiday's going to be in there for a while, and that's my benchmark. Some of these things we were looking at the beginning were 1 week data. 1 week data fluctuates. It gives you an idea with the markets changing, where 5 weeks is supposed to be more stable. Coming down to condos, Santa Clara County, a jump of 10 days, and base cities, a jump of 13 days. The frequency of overbidding down from 88 to 86, 87 up to 87. So we had one go the opposite direction, basically flat at 88 to 88, and 78.5 to 76.5. Magnitude of overbidding, more stable, but mostly in the downward direction, 113.5 to 112.5. Call that flat. I'd even call this flat. I call that flat. So they're pretty much all flat except for single family homes in Santa Clara County. Appreciation. Now, this is a little different than most people. The peak appreciation in 2021 was 24.8% over the entire 2020 calendar year, and that happened on June 29th for Santa Clara County single family homes. Then in 2020, the peak was at 39%. Right now, you're only at 38.7%. In San Mateo County, the trend is similar, 24 to 37, but it's down to 29%. So it's had a bigger drop from its median, and its median in 2022 did not get as high as Santa Clara County. Same concept for condos, 18% to 30%, 31. So condos in Santa Clara County are still appreciating at this point. Condos in base cities, this again is sort of garbage number. You had 18% in 15% in 2021, only 8% in 2022, and 1.9% now. That is not indicating property values are going. They built a whole lot of lower end townhouses, condos, which just brought down the market. It didn't bring the market down. They're building higher density, which is less expensive because you have less land, which brings down the pricing when you look at that whole component. And that's something a lot of people don't understand, is anytime you look at macro data, it does not necessarily reflect what's happening to property values, just like what's happening in the 9 Bay Area counties doesn't reflect what's happening in any one county. Here I am now expanding to 2 more counties, Alameda County and Contra Costa County. Not as much detail, but it's pretty useful information here. You basically have the new listings from last week and then this week and the percent change. So you can see the percent up in all categories except for San Mateo County condos and townhouses from last week to this week. So there was more new listings. And that's because last week, the number of new listings would have been down because of Memorial Day. The active inventory is up quite a bit, basically across all the components. And then the number of new listings to total of listings, which I'm not sure is a meaningful data point, but I'm tracking it to see what ends up happening. Then you look at offers accepted. You can see offers accepted are across the board. That's because last weekend was the holiday weekend when most of the people most consumers are doing their activity. So there's less offers being accepted this week. The key takeaway here is DUI. I have two different numbers. The first number here is based on 1 week data, and then I have 5 week data down here. So you can see your 5 week data is a lot more stable, but it's now in that 40 to 80 range, which I say is a balanced marketplace. Condos are a little stronger, but still very right on that threshold. The single week data points you can see fluctuate a lot more. You went from 33 to 77. And the reason for this is mostly the huge drop in the number of offers. The offers dropped 50% in San Mateo County. You went from 93 to 46, but 46, when you have 500, is a small component of the overall marketplace. Then you get down to closings down here, and you can look at whatever data point is interesting for you, from price range to the different areas to the magnitude of overbidding. And again, I do my appreciation over 2020. And the reason I do that is if I pick a week over week, it would fluctuate on both the base and the new, and you wouldn't be able to tell the significance of what's really happening. Here's looking at almost apples and apples comparison. It's what I call my May data. I normally collect this on June the 5th, so I'm 1 day short, but it gives you a 20-year recap of where we stand. We have 146 properties on the marketplace. You can see pretty quickly that, it's on the low end of where we are, but we're got quite a bit more than we do last year. We have about the same that we did in 2020. You can look down at days of unsold inventory in the purple, 36.8. That is actually one of the slower marketplaces when you start going back. Similar to 2020, but think about it. 2020, we were just coming out of pandemic on June the 5th. Basically from March the 1st to someday I don't remember in April, we weren't supposed to show any houses. Then from that date in April to May 1st, we could only show vacant homes. It wasn't until May 1st we could show homes again. But to have the DUI to be the same as a month after where we had a complete shutdown is pretty significant. 19 was slowing down, but look at back here. These numbers here are pretty much lower until you get way back into 2010, 2008, 2009, when you had a lot of inventory. So this is a pretty slow marketplace for this time of the year. And then look at the number of sales. You're under 1,000. Again, that's essentially a record low. Yeah, it's the same as 2020, but in 2020, closings on June the 5th would have been closing that basically happened during the pandemic. And yeah, I closed two that would have counted in this group, but still, to be that low, that's got to be a red flag for anybody. You come down and look at your sale price, $1,900,000. It peaked out at about 1970, if I remember correctly, during the middle of the month. So we're down a little bit, but not dramatically. And with that, we should be back to questions. And if I don't have any questions, I'll wrap it up and see everybody next week. Any questions for me? All right. Have a great week, everyone.
Hey, thank you, Richard.
You're more than welcome. Thanks for joining.